this brings us to the second part of our four-step process in solving things. We've classified all accounts. Now we've got to do the calculation and balance day adjustments. So let's go to our spreadsheet and let's grab the different things that we've got to do. I would suggest doing this on paper that you then add into the accounts. So the first thing is we've got a stock take value, 43,500. So if we go to inventory control, we see that it is $45,000. When we go back to here, it's 43,500. So there's a loss of 1,500. We have to reduce inventory control to 43,500. And we have to add the relevant expense account. So we've got an inventory adjustment of $1,500. So let's have a look at those two things. Inventory control goes to 43,500, and then we add down here an expense account, inventory expense adjustment, and we've changed it by $1,500. It has a debit nature. And we can see down the bottom, if we write that this is our check, we can see that once we've made those adjustments, we've got an expense of $1,500 here, and we reduce inventory control by $1,500 here, we've still got a balanced situation there. So that's the first thing that we've got. Okay, the second thing is office equipment is to be depreciated. So if the useful life is 10 years and the residual value is 20,000, we've got to look at what we've paid to start with that office equipment. Office equipment has a value of $85,000. So starting value of $85,000. So the depreciating amount is that $85,000 less the $20,000 that remains at the end. So that's $65,000, and the depreciation for a year equals $65,000 divided by 10, which equals $6,500. So now that's our depreciation. So that's going to be our depreciation expense for the year, and we're going to have to add that to accumulated depreciation, the total amount of depreciation. So let's go and have a look and see if we've got accumulated depreciation for office equipment. You have, and in this case we've got to add another $6,500. That's going to be $18,500. And we're also going to have to add the expense account, which is the depreciation, just in the current year, just this 1 year of depreciation. Depreciation for office equipment, she said was $6,500. And again, we can see that it checks. We're going to have to go to insert a few rows here. And we'll just check that our formula still works in there as well. That'll at least give us a few more that we can do. Okay, so that's our second calculation done. The third one, motor vehicles are to be depreciated using the reducing balance method at the rate of 25% per year. So let's think about the starting value is going to equal whatever we paid for the motor vehicles minus the accumulated depreciation. Okay, when we look at that on our graph, motor vehicles we started at $62,000. And the accumulated depreciation so far, the amount they've gone down in values so far, is $12,400. So the starting value of this is going to be $49,600. So to find the depreciation for the current year, it's going to be 25% of $49,600, and 49,600, if I just do it over here as a sum, equals 0.25 times 49,600. It's going to equal $12,400. We have to do the same thing we did last time with the previous calculation and say, okay, accumulated depreciation, which is $12,400, is going to go up to $24,800 because we've added another year's depreciation on, and we're going to have some depreciation as an expense. The motor vehicle, this is the expense for the year, and if my memory is right, $12,400. If I want to check that the formulas, whether they're still all the way down, if I click on the formula box and click here, it'll highlight everything that we need to. So we're going to have to drag that down in a sec. So if we go all the way down to 35, just so that we're adding in all the adjustments that we'll make. So far, so good. Let's have a look at the next calculation. Okay, fortnightly wages are paid based on a 5-day working week. So 10 days. So 10 days work in a fortnight and total $11,000 a fortnight. So daily wages equals 11,000 divided by 10. So we're paying in wages $1,100 per day. You'll notice that when you look at the wage expense isn't that high, so they must have just put on staff at the end of the year. So daily wages $11,000. 3 days wages are owing on the balance day. So wages owing equals $3,300. So that is going to be an accrued expense, which is a liability. And as well as that, we're also going to have to increase our wages by $3,300 because there's an extra $3,300 of work that's been done that hasn't been accounted for in the budget, in the accounts yet. So let's put this down as a liability account. As a liability account. It's an accrued expense. And liability accounts have a credit nature, so we're going to be putting the $3,300 into here. Now we also have to add to our wages account $3,300, so that's going to make that $48,300. And once again, we balance at the end, so we're happy about that. Okay, it's another calculation down. Let's have a look at the licensing agreement. Okay, so we have to go and have a look at the value of the licensing agreement, go and look at our accounts. The licensing agreement was, we've paid $12,000. So, for example, licensing might be that we've got the right to distribute One Direction merchandise for the next 10 years in Queensland. In the excitement of One Direction, I forgot what the number was, $12,000 that we've paid for it. Okay, so $12,000 for the licensing agreement, amortised over 10 years. So it would usually be a 10-year agreement that we've got. So therefore, the amortisation will be $1,200. In this case, over 6 months, because we bought it on the 1st of January, so we've only owned it for 6 months, so it's going to be $600 of amortisation. Amortisation is very much the same as depreciation. So we're going to have two different accounts. We're going to have an amortisation expense, which is going to have the $600 for the year in it, plus accumulated amortisation, which is going to be a negative asset account, and it's going to be worth $600, just like the accumulated depreciation. So let's pop a couple more rows in. So we're going to have to add both of these accounts because we don't have an accumulated amortisation there. So the first one we'll pop in is expense account, which is amortisation for the license, and over the year it's going to be $600. Then we've got the asset account, which is going to be accumulated amortisation. So all the amortisation to date, which is just this 1 year's worth, the $600. And you can see that much like the accumulated depreciation, it's got a credit value. So we're feeling that we're pretty comfortable with that. Okay. The next one is rent of 3D300 received from tenants on the 1st of June for 3 months rent in advance of that day. So the rent's been collected effectively for June, July and August, but only one of those months has actually happened so far. So the first thing we might do is work out the rent per month. It's going to equal 3,300 divided by 3, which equals $1,100. Now, I think that should have... Now, there's 2 months that's been collected ahead of time. So that is actually unearned revenue. 2 months of that is going to be 2 times 1,100, $2,200. That's our unearned revenue, and we're going to also have to reduce rent revenue by $2,200. So let's go and have a look at that. Let's add our unearned revenue account first, and unearned revenue is a liability because we've still got to do the work to earn that money. Unearned revenue. And liability accounts have got a credit nature. So unearned revenue is $2,200, and our rent revenue, when we go up and find that, I just see it in there, rent revenue. Unearned revenue is a liability, so it should have a credit nature. That's right, and unearned revenue, this rent revenue, it's going to decrease by $2,200. So it's going to go to $14,300. And if we go back to our check, we're still in balance because we've had an increase on this side, increased credit, and a reduced credit on this side here. Okay, we're getting well through this. There are 4 things to go. Spoken event and have not been paid yet. The agreement was that you'd be paid 15% ticket sales for $22,000. So the amount outstanding is going to be 15% of $22,000, which we can use our calculators and work it out. I think it should be $3,300. So this is an amount that you've earned but haven't yet received. So it's going to be accrued revenue, which is an asset. It is going to be $3,000, and we will increase our service revenue by $3,300. So let's go and have a look and see if we can do those 2 things. Service revenue is $4,000, so we can go $7,300 That's what we've earned for various services. And we've got an asset here of some accrued revenue. And that's going to have a value of $3,300, I think it was. If I can just check back here. So now that hasn't balanced. So accrued revenue as an asset should have a debit nature. Service revenue should have a credit nature. So I've popped that on the wrong side. So if I can just make a couple of adjustments, let's put it on the right side, 7,300, and add to that the other 3,300 to take it 10,600. And I'm just going to adjust the capital just to make sure everything balances again. So that'll be right when you look at it. I had that on the wrong side. So service revenue, we increased service revenue, and we had a bunch of accrued revenue. We're going to have to pop in a few more rows. Okay, and making sure our sum comes all the way down there, which it does, all the way down there, that's right. It doesn't matter that accrued revenue's gone down there, there's no particular order at this stage as long as we don't forget about it at the bottom. Okay, that was our accrued revenue. Okay, on March 31st, a 6-month advertising, so that's an expense, an advertising campaign was paid for and started. 31st of March, so we've got April, May and June, 3 months in this financial year, 3 in the next. So $1,000 is a prepaid expense. Okay, so the prepaid expense, that's actually an asset account, and we're going to have to reduce advertising expense by $1,000, by half the amount, because 3 months have happened, 3 months haven't yet happened. So we've got in, we need an asset account, which is prepaid expense. Asset accounts have a debit nature, so there's going to be $1,000 in there. And we're also then looking for our advertising expense. Here at $6,000, we have to reduce it by $1,000 to make it $5,000. We check down and we can see that everything is in balance again. Down to the last couple. Okay, interest on the government bonds. Interest for a year is going to equal, we've got to work out how much government bonds we have, $20,000. So we've got $20,000 worth of government bonds by 8%, which is going to be $1,600 per year. However, they were purchased 9 months ago, and there's not going to be any interest paid for another 3 months, but there's some interest has already accrued. So it's going to be an accrued revenue, and it's going to equal 3/4 of a year because 9 months interest is accrued. So you could say it's 3/4 of 1,600, which equals $1,200. So we're going to have some interest revenue equal to $1,200, and accrued revenue as an asset. And I think we've already got some accrued revenue, so we can add the $1,200 onto that to give us $4,500. Now, whether we have any interest revenue yet, I would suggest that we may not. So if we can't find it there, we need a new revenue account, interest revenue. Revenue has a credit nature, so that's going to be $1,200. And once again, we check and it's balanced nicely. And the last thing, we don't actually have to do any calculation. The business has never had a loss because of fire before. If I just go out, I'll get rid of this row that we don't need. We've got the balancing amounts, and we've now made all those adjustments to our account. And we're ready to start to put together the next two things, our balance sheet and our profit and loss statement. And we will have to start with our income statement, our profit and loss statement, because we need to know what our profit is for the year to take that across to our capital account.